Have you ever noticed the headlines saying something to the effect, the Fed cut rates, and then you check the news and see that mortgage rates actually went up that same day? This feels very confusing, right? Most people think when the Fed cuts rates, mortgage should also be cheaper, but that's not how it always works. Here's the truth. Mortgage rates don't actually move directly with the Fed rate. Instead, they are based on what the banks and investors think will happen in the future. It's all about anticipation, confidence, and risk. So in this video, I'm going to break it all down step by step. First, we'll talk about what the Fed rate really is and what it isn't. Second, I'll explain what really drives mortgage rates. Third, we'll look into why rates sometimes go up when the Fed cuts. And last, I'll give you a few smart tips so you can make the best decisions when you're buying or refinancing a home. And don't worry, I'll keep it simple but detailed. By the end, you'll understand exactly how mortgage rates really work, and you'll feel much more confident making a smart home buying decision. All right, let's start with the basics. When you hear the Fed cut rates, most people think that means mortgage rates drop too, but here's the thing, the Fed rate is not mortgage rates. The Fed rate is called the federal funds rate. This is the short-term investment rate that banks charge each other when they lend money overnight. Think of it like this. If two banks are neighbors and one needs some cash for the night, they borrow it from the other at this special rate. This rate matters because it influences the cost of borrowing across the whole economy. When the Fed raises the rate, borrowing money for things like credit cards, auto loans, and business loans get more expensive. And when they cut it, those things usually get cheaper. But here's the catch. Mortgage rates are long-term loans. A 30-year mortgage is very different from a short-term overnight loan between banks. So mortgage rates don't move in perfect sync with the Fed rate. Instead, mortgage rates are influenced by a mix of factors like inflation. If prices keep rising, investors want higher returns to protect their money. That pushes mortgage rates up. Then there's the bond market. Mortgage rates often follow the 10-year Treasury bond because that's seen as a safe bet. When investors worry about the economy, they put money into bonds, and that affects mortgage rates. There are expirations for the future. This is a big one. Mortgage rates often move in what investors think will happen, not what's happening today. So when the Fed cuts or raises rates, it's really just a sign. It tells the world how the Fed feels about the economy, whether they're trying to cool things down or give it a boost. And here's what's super important to remember. Sometimes mortgage rates have already moved before the Fed even announces anything because the banks and investors are guessing ahead of time. So now that you know the Fed rates and mortgage rates aren't the same, let's talk about what really drives mortgage rates. Here's the truth. Mortgage rates move based on money markets and investor behavior, not just what the Fed says. The biggest factor is something called the bond market. Now, don't worry, I'll keep it simple. Think of the bond market like an IOU the government sells. One of the most popular ones is the 10-year Treasury bond. Investors all around the world buy these bonds because they're super safe. Here's the connection. Mortgage rates usually move in the same direction as the 10-year Treasury bond yield. Why? Because investors see both as long-term investments. If the bond yield goes up, mortgage rates usually go up. If the bond yield goes down, mortgage rates usually follow. Now, why does the bond yield move? They move based on how investors feel about the economy. If investors are nervous and think the economy might slow down, they buy safe bonds. When lots of people buy bonds, the yield goes down and often helps mortgage rates go down too. If investors think the economy is strong or that inflation will stick around, they might sell bonds. That pushes the yield up and mortgage rates go up with it. Here's another big factor, inflation. Mortgage lenders hate inflation because it eats away at their value of money over time. If lenders think inflation will stay high, they'll charge higher mortgage rates to protect themselves. And finally, here's something most people don't realize about mortgage rates. They move on expectation about the future, not just today's news. Let me give you an example. Let's say the Fed announces they're cutting rates. You might expect mortgage rates to drop right away. But here's the twist. If the market already expected that cut, mortgage rates may have dropped weeks in advance in anticipation of the cut. Or if the market thinks the Fed cut means inflation could heat up again, mortgage rates might actually go up higher. So when we hear and see news, the Fed cut rates and mortgage rates rise the same day, it's not a mistake. It's the market reacting to the bigger picture, not just the headline. That's why watching mortgage rates is a little like watching the stock stock market. They can move fast, and sometimes the reasons aren't obvious until later on. So this part is confusing to everyone. The Fed cuts rates, but instead of mortgage rates going down, they actually go up. Why does that happen? Let's break it down step by step. First, remember the Fed is mostly fighting inflation. When they cut rates, it usually means they're trying to boost the economy, make borrowing cheaper for businesses and people. But here's the tricky part. If the market thinks cheaper borrowing will heat up the economy too much, they start to worry inflation will go higher in the future. And remember what I said earlier, mortgage lenders really hate inflation. If they think inflation is coming back, they'll raise mortgage rates fast to protect themselves. So even though the Fed may cut rates, mortgage rates can jump because investors are nervous about inflation. Now, let's add another layer, expectation. By the time the Fed actually cuts rates, investors may have already guessed it was coming. In fact, markets often price it in ahead of time. That means mortgage rates may have already dropped before the Fed made a move. So when the cut finally happens, the news isn't new. Instead, investors start asking, what will the Fed do next? Is this enough to fight inflation? Or could this make inflation worse? If they think the cut was too much or not enough, mortgage rates can react in surprising ways. Here's a simple way to think about it. The Fed sets the short-term rates. Mortgage rates move on feelings about the future. So if the future looks risky, mortgage rates go up, even if the Fed tries to lower borrowing costs today. Let me give you another example. Imagine the Fed cut rates because they see signs the economy is slowing, but right after that, a new jobs report comes out showing the economy is actually stronger than expected. Investors might think, uh-oh, inflation might stick around longer, and bam, mortgage rates go up that same day. It's not about the Fed's single move, it's about the whole story investors are telling themselves about what's happening next. So now you might be thinking, okay, this is interesting, but what does it mean for me if I'm trying to buy a house? Great question. Let's talk about that next. Here's the first thing you need to know. Mortgage rates can change daily, sometimes even multiple times during a single day. That means timing the market perfectly is almost impossible. Think about it like trying to guess the exact day gas prices will drop at your local station. You could wait and wait and wait, hoping for a better deal, but by the time you go to fill up, the price might already be higher. Mortgage rates work the same way. Second, don't get discouraged if rates are higher than you hoped. Remember, your payment today doesn't have to be your payment forever. If you are buying a home and rates drop later, you can always refinance. That's one of the most powerful tools homeowners have. Here's what matters more than timing: knowing your numbers, understanding your budget, having a plan that works in today's market. That's where pre-approval comes in. When I help clients get pre-approved, they see exactly what their payment looks like based on current rates. That way, they're not shopping blind. They know exactly what they can afford. Another important point focuses on the house payment, not just their interest rate. A lot of buyers get so caught up waiting for the perfect rate that they miss out on the home they really want. And meanwhile, prices continue to go up. Let's look at another example. Imagine you're waiting for rates to drop by 0.5%. That might save you a couple $100 a month, but if prices rise by $50,000 while you're waiting, your payment could actually end up higher. So the smart play, focus on finding the right house that fits your life and your budget today. Then when rates do drop, we'll work together to refinance to the lower payment. And here's one last tip. The strongest buyers aren't the ones that wait. They're the ones who have prepared. They've got their credit ready, their pre-approval in hand, and they know exactly what they can afford. That way, when the right home hits the market, they can move fast. So we've talked about why rates move and why it doesn't always match what the Fed does. Now, let's talk about how you can stay ahead of the game as a buyer. First strategy, get pre-approved early and keep it up to date. When you get pre-approved, you know exactly what you can afford today, but here's the secret. Pre-approvals don't last forever. They usually expire after about 60 to 90 days. So if you're serious about buying, keep your pre-approval current. That way, if rates shift or your income changes, you'll always know exactly where you stand. The second strategy, know your comfort payment. A lot of buyers focus only on the house price, but what really matters is your monthly payment. Before you start shopping, figure out the payment you're comfortable with, whether that's $3,500, $4,500, or whatever that number is. Then work backwards with your lender, like me, to see what home price fits that payment. That way you won't fall in love with a house that stretches your budget too far. And the third strategy, plan for a refinance. Think of buying your home in 2 steps. Step 1, buy the house you love at today's rate. Step 2, if rates drop later on, refinance to a lower payment. That way you get into the home sooner instead of waiting around and risking higher prices. Fourth, don't try to outguess the market. Look, even the experts on Wall Street get it wrong. Sometimes trying to time the perfect moment is like trying to guess the winning lottery number. Instead, focus on your timeline and your needs. Are you ready to settle down? Do you need more space? Do you want to start building equity? Those are the real questions that matter. And my final strategy, build a strong team around you. Buying a home isn't a solo mission. You want a great real estate agent who knows the local market and a great mortgage broker who can guide you through the loan options. With the right team, you'll be prepared for whatever the market throws your way. So remember, rates will always move up and down, but if you have a smart plan, you don't have to be scared of the ups and downs. You'll be ready to take advantage of them. All right, let's do a quick recap of what we covered today. The Fed sets short-term rates, but mortgage rates don't always follow right away. Mortgage rates move based on investor expectation, the bond market, and inflation fears. That's why sometimes mortgage rates go up on the very same day the Fed cut rates. And the key takeaway, don't panic. What matters most is having a plan for your budget and timeline. Here's the truth. You can't control the Fed, you can't control the headlines, but you can control your credit, your savings, and the team you work with. And remember, this buying a home isn't about timing the market perfectly. It's about timing your life. If you're ready to settle down, build equity, or stop renting, the best time to buy might be sooner than you think. So here's your next step. Call or text me today. I'll show you exactly what you can afford right now, walk you through rates, and create a plan that works for your budget, even if rates change tomorrow. And if this video helped clear things up for you, do me a favor. Hit that like button, subscribe to the channel, and tap the bell so you don't miss the next update. Also, leave me a comment below. Tell me, are you more worried about rates or about home prices? I'd love to hear what's holding you back. Thanks for watching, and I'll see you in the next video.